So this is an interesting chart. It looks at the return paths, or the annual path of the S&P prices during election years. And it looks at it from the perspective of whether an incumbent party wins or an incumbent party loses. And you can see the bottom line there. If an incumbent party loses, historically, it's been a weaker return, whereas if an incumbent party wins, it's historically been a stronger return. Now, this analysis also excludes 2008, obviously given the global financial crisis and Great Recession that hit. But so historically, generally markets have preferred an incumbent winning. But again, I would say that there's a lot of variation around that. And so another way to look at it is how the market has performed in election years. So if we move to the next slide, this takes a different lens, and it says, okay, let's look at all let's look at all years where there have been elections and there haven't been elections. Has there been a difference in the returns? And historically, non-election years have produced on average a higher return than election years, looking at both the presidential election years as well as the midterms, where a portion of Congress is elected. Now, the analysis can also exclude 2002 and 2008, which happened to be election years that were occurring sort of at the beginning or during a recession. And so once you even adjust for those years, generally the markets have done better in non-election years than election years. But probably the key takeaway I have from this one is that whilst the gap looks large on average, there have been many election years where the returns have been very positive. So there's a pretty low signal here, but nonetheless, it's still interesting to see that generally, I guess, election years are prone to uncertainty, and maybe that's what weighs on the market. We can also take another lens and have a look at the years. So if we move to the next slide. So what we can see here is the average return for the S&P 500, so the total return, looking at year 1, year 2, year 3, and year 4. So year 4 being the election year. So breaking it down a little, so we can see a bit more about these sort of, let's call them the non-election years. And what you can see is that really it's the pre-election year that has had the really high average return based off the sort of 1926 to 2019 data. It's generally been the highest returning year, and it's generally had the most positive returns over the period, whereas the sort of post-election year and the midterm year have been those that have had lower returns and less positive. But the returns have still been good on average across the board, and not that different. If you look at the post-election years and the midterm year, they're not that different to the long-term average return for the S&P 500. So again, looks like a big gap on the year 3, but actually if you tried to time that, if you go back and look at the range of outcomes on that year, it's quite wide. So even though there appears to be a divergence, it's not quite as strong as it appears. But nonetheless, historically, that year before the election has been better than the election year, and again, likely due to the fact that markets don't like uncertainty. So we can also have a look on the sort of monthly cycle. So looking at the sort of how have the average monthly returns looked during election years. So only looking at the years where there have been elections, we can look at what the returns were each month. And so as you can see, there's a lot of variation, but November, obviously being the election month, that actually in an election year has generally been the highest returning month on average. Again, wide range of outcomes. This is just an average, but that's generally been the stronger. Again, it potentially supports the view that markets dislike uncertainty and they prefer certainty. What is really interesting is that the preceding months on average have generally been the lowest. So September, October leading into the election. Now, October has historically been a very weak month for the stock market. So, you know, whether that actually relates to elections or whether it relates to some other behavioral element that makes people dislike October as a month, maybe it's because they're getting closer to the winter. But so historically, there does appear to have been some patterns in the annual and monthly returns, but those are very noisy patterns, and so generally we would not put a lot of weight on trying to adjust one's investment strategy based off the election cycle. And we'll move to the next slide. One of the reasons is that over the long term, equity markets go up, and trying to time markets so let's say be out of the market and in cash, is actually really hard to do. And so if you don't have a strong signal, then you can miss out on a lot of opportunities. Certainly post World War II, the Democrats have produced slightly better returns than the Republicans, but it's been relatively modest. And so overall, whilst there are some patterns, we don't think it warrants an adjustment to one's investment approach if you're a long-term investor. And another key point is that trying to predict outcomes and invest according to your prediction is really hard, because you have to not only predict the correct outcome, you have to determine whether or not the market is priced in that outcome or not. So even if you are right, you could still not win if the markets actually have more than priced that result in. And we've seen that in some of the events around Brexit, Trump's election in 2016, where everyone was convinced it was going to be a bad outcome for the markets, but they were obviously wrong. And so it's a really tough game. And so we're more interested in looking at what maybe the different political parties could mean for the economy, and then trying to work out whether it could have a long-term effect and how we should adjust our models. But that's kind of, I guess, a whistle-stop tour of the presidential return cycle.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.